we do have the inflation number 6.5% for the month of January. This is versus a figure of 7.4% in the month of December. Now remember, we were expecting a decline to come in. It's really come in line with what the ET Now poll had expected. As I mentioned, 6.6% is what we were really expecting. Two factors which have largely led to a decline in the January inflation number, which has come in at 6.5%, and that would be your high base effect, and you are expecting the inflation to stay in a moderated territory over a month-on-month basis. We are anticipating all of the internals for inflation, particularly the primary articles inflation. That too is expected to decline this time around on account of the high base effect, as well as the moderation that we have seen in your food articles as well as your vegetable prices. The trend for inflation this time around for FY13 also is expected to stabilize somewhere between 6.5% to 7%. There you go, primary article inflation currently at 2.2% for the month of January. You have the fuel group inflation, which has come in. It has tempered down to 14.21%. This is 14.9%. But the WPI inflation number at 6.5%, I think, will certainly be digested well. Manufacturing at 6.4%. This is coming in versus a figure of 7.4% in the month of December. Remember, the trajectory for inflation, what we're expecting in FY13 also, is expected to be at around in the range of around 6.5% to 7% on account of the stable commodity prices as well as the weak domestic demand. And the economists, by and large, aren't expecting the inflation to come down to the comfort zone of the RBI, which is at around 5 to 5.5% in the month of March. But meantime, let's see how the markets are digesting all of this information. You've got the Sensex, which is higher by 73 points as we speak, and 5,400 is being held onto by the Nifty. Would be prudent also to pull up the Bank Nifty as well as some of your rate sensitive to find out how they are trending as we speak. So the Nifty clearly up by 0.5% reacting to that number. 6.5% for inflation is in fact the lowest value that we have seen since the month of November 2009. The bank index also close to the highest point of the day. Sajid Chinoy, India economist at JP Morgan, now joins in to dissect the numbers further. 6.6%, Sajid, how would you react to that?
Broadly in line with expectations. I think most people expected somewhere between 6.5 and 6.8. What we have to keep in mind is there is a very substantial base effect at play. If you remember, last January, inflation rates for all categories, primary articles, energy, manufacturing, the index rose very sharply. So there's clearly a very favorable base effect. Having said that, I think the encouraging aspect is that food prices sequentially seem to be coming off, which is a good sign. The question is, can this sustain? And today's number would suggest that the sequential momentum of core inflation has also slowed in the month of January, which is a big positive. Again, the question going forward is, can this sustain, given that crude prices have picked up pretty sharply over the last month or so? But on the whole, broadly in line with expectations and helped significantly by a base effect. It sort of ties into what the finance minister said, which is that inflation, though coming off, is still very high. Close to 7% is still very high, which is why the need for credible fiscal consolidation in this year's budget is very, very important. It's very difficult for the RBI to be cutting interest rates at the same time that fiscal policy is loose and putting pressure on inflation. I think if you see credible consolidation in the budget, and you see that the rupee does not depreciate again, and you see that crude prices don't surge or go up too much more from these levels, then there is perhaps a case for a rate cut at the April review. But I think that's the earliest at which the RBI will visit that subject.
All right. Sajid, you were just talking about the Indian rupee. What is your view on Indian rupee for FY13 and the risk to inflation due to depreciating rupee?
Yeah. I think the risk of a depreciating rupee and inflation is very strong. If you look at the evolution of core inflation in 2011, core inflation was actually coming off in a sequential basis in June and July and August. Then you've got a massive plunge of the rupee, and that is very strongly correlated to core inflationary pressures rising for the second half of the year. So clearly what happens to the rupee will be a very important determinant in core inflation and therefore headline inflation. The fact that the rupee has bounced back so sharply in January has in fact helped inflationary pressures, as we found out this year. Going forward, I think a lot will depend on two factors. Global risk aversion. We've seen that the rupee has become kind of hostage to risk off, risk on trade. Risk was off in last year, and the rupee, like other emerging market currencies, South Africa, Turkey, Mexico, Brazil, saw a very sharp depreciation. Risk is on in January, and see the rupee bounce back sharply. So a lot will depend on global factors. But I think there's a lot at stake in the next 2 months. We've got important state elections, we have an important budget, and we have a budget session of Parliament. If policymakers can grab those opportunities and domestic sentiment were to go up, I would expect that capital flows would rise pretty sharply, and that would be very supportive of the rupee.
Sajid also wanted to get in a word on the yield on the 10-year bond, given that we have had calibrated efforts from the, in terms of the OMO action. We saw that CRR cut. How do you expect the bond markets to read into this inflation number and now trend going forward? Yeah.
I mean, we have to realize that the bond rally is a bit artificial in the sense that this year's fiscal deficit slippage will be above 1% of GDP, which ordinarily would have meant a big sell-off in bonds. But the fact is the RBI has been doing sustained open market operations for the last few months, and that's the only reason why we've seen bond yields where they are. I think going forward, a lot will depend, on the RBI's policy, but even more so on what the borrowing requirement for next year is. If you have a very large borrowing requirement in 2012-13, and if credit growth, which has been very weak so far, picks up, then that will not be good news for bonds. You could see a sell-off in bonds if you've got a sobering budget. So I think the outlook for bonds will depend very much on how the budget turns out and and how credible the budget is and what the borrowing requirement for next year is.
Sajid, now in the recent monetary policy, RBI had mentioned that suppressed inflation in petroleum products and coal prices remain significant. What is your view on the prices of both petroleum products and coal and its impact on inflation?
Well, with crude prices increasing the way they have over the last 2 weeks, the under-recovery is getting larger and larger. And these things are not unrelated. If you have to have credible fiscal consolidation, you'll have to see some increase in these administered prices of diesel, of LPG, of kerosene to reduce the fiscal burden. And that in turn will have an impact on prices and inflation later in the year. The RBI knows that very, very well, which is why I believe that they will not be in any haste or hurry to cut rates until they see the budget on the 16th of March.
Going forward, Sajid, what's your trajectory in terms of inflation? Do you think it will stabilize at these kind of levels? Do you think that the weaker rupee, the higher oil prices, all of these demand conditions will be factored into the number then?
Yes, I mean, I think the number is going to look better over the next couple of months because of the base effect. You probably go below 6.5% in March. The problem is what happens when the base effect gets over. And in our view of the world, given where crude prices are, given the constraints on fiscal policy, and given that the rupee is going to be hostage to global conditions, we actually see inflation ticking back up after April when the base effects wear off. So we still believe, given the structural drivers of food inflation and given where oil prices are, inflation goes back up towards the 7.5% mark for the second half of 2011. Now that won't be enough for the RBI to increase rates, but what that will do is constrain their ability to cut rates substantially, like what the market's expecting. So we don't think you'll get perhaps more than 50 basis points of rate cuts at most at this point, given where crude and commodity prices are.
All right, and finally, what is your outlook on economic growth in India and the drivers for the same?
Yeah. I think critical to growth next year is going to be the corporate investment cycle. I think we've been waiting for a long time for that to pick up. Investor sentiment is very low. And I think if the investment cycle does pick up, then we do see growth accelerate from these levels and move up towards the 7.4, 7.5% mark next year. But that's going to depend crucially on policy actions. As I mentioned, if you get credible fiscal consolidation, if you get some reforms pushed through so that some of these supply constraints are released, the coal power linkage, land acquisition, rationalization of subsidies, perhaps reintroduction of multi-band FDI, all of those actions will go a long way, I think, in boosting investor sentiment, attracting more FDI flows. And if the investment cycle does pick up, then you do have growth accelerate. If, however, this sort of policy malaise continues for much longer, then I think the growth disappointments of this year could continue into next year as well.